Hi, I'm Kiran from Borrower First. We specialize in reducing mortgage repayments to pay off your loan a lot faster and own your home a lot sooner. And I'm really pleased this morning to have with me Stephen Dinty, not only a colleague, but one of the senior most and most statesmanly-like mortgage brokers in Australia. Steve, thanks for joining me this morning. I'm going to take you through a couple of questions this morning regarding home loans. And if you'd love to give us your take, because you've been in this industry now, how long?
All up now, 50 years.
Wow, that's a long while. In that period of time, what has really changed with the mortgage broking or the finance industry in Australia?
But where to start? There's been so many changes over the years, Kieran. Back in what I term the good old days, the methodology of determining borrowing capacity was based on what we call demonstrated capacity of the applicant. So that was taking into account their savings, taking into account the rent they've been paying, and then determining the borrowing capacity based on the sum of those two numbers. And look, going even way back before I started, that was the way it was done, and that was fine. Mind you, back in those days as well, the two things, salaries, wages were a lot lower than what they are today, naturally, and so was the price of homes. So it was a lot easier. Quite often, home loans were based solely on one of the applicant's income. So you'd have a couple, and the loan would be just based on one of those two, invariably the male, because back those days, the women, I think of even my own mum. My own mum had to stop work when she got married.
Wow.
Because married women were not allowed to work. So home loans were based on what the man was earning, and that's how it happened back then.
We've come a long way since then, haven't we?
We've come a very long way since then. I remember when things changed and we used to take 100% of the man's income and 20% of a woman's income in determining borrowing capacity. And today, obviously, we're taking 100% of both, and invariably the primary borrower is the female. Quite often these days I find women are earning much more money than the male counterparts.
Very true. Coming down to where we are currently in this cycle, we get questioned a lot regarding fixed rates. Yeah.
Yep.
And would you advise a person at this point of time on how to manage fixed rates?
Historically, if you took two couples and their loans, and one couple only took fixed rates and the other couple only took variable rate, the couple with the variable rate would have won out over time.
Okay.
Because obviously variable rates are moving up and down as much as they do. At the moment, we have a scenario where the banks are offering significantly lower interest rates on their fixed term loans, usually 2 to 3 years. Compared to the variable rate that they're offering. Appreciate that banks are in business for profit. And we see the profits that the banks declare in terms of billions of dollars every year. The reason the banks are offering these lower fixed rates at the moment is because they're trying to lock in clients, knowing full well that next year at some point in time, based on what all of the economists are saying, that interest rates will come down. So if you've taken one of these fixed rates today and then next year rates come down on variable, you're locked in, and it would actually cost you money to get out to then chase the lower variable rate.
Awesome. We've got a lot of people who might try to hedge their bets on that kind of a discussion, putting part on variable, part on fixed. What kind of percentage and how would that work for most people?
There's no hard and fast rule on that type of scenario. And it's not a bad strategy to take. It does depend a lot on the plans that people have for themselves and their family moving forward. So, for example, if you were thinking of moving home in say in 2 years' time, then it would be counterproductive to lock in a 3-year fixed rate.
Very true.
So you might lock in part of your loan on 2 years and keep some variable. If you, for example, are in a position where in your job, you may get bonuses, and say an annual bonus. Then having a fixed rate's not a great idea because there's limitations to extra payments, where if you have part of your loan on variable and you do get a bonus, then you can just throw that bonus at your home loan, which is a good way of using your bonus to bring down the debt on your home loan.
Excellent. Thank you so much for that. I think it's going to help a lot of people. How about giving me a bit of an understanding, because earlier we were mentioning about there's certain fixed rates at the moment with offset facilities, and I don't think many people know about these because, as you can appreciate, the major banks actually don't provide that facility, do they?
That's exactly correct. And the reason they don't offer that is it's a system-related problem for the banks. The computer systems that they're running don't allow for it. Historically, there are a number of building societies and credit unions that their systems did allow for a fixed rate with an offset. Over time, with the mergers of the different companies and the reduction in the overall number of lenders, sometimes that's gone in with the lenders. But it's curious you mention it because we actually have here now a situation where there is a merger of two banks.
All right.
One of those banks does currently offer a fixed rate with 100% offset. The other one doesn't. And they're looking forward to, after the merger, to be able to then offer that to their client base.
That's going to be good.
Fixed rate with the 100% offset. It's a sort of best of both worlds.
Absolutely. So touching upon these features that home loans have, you mentioned the offset and there's also the redraw facility. A lot of people sometimes might put more money into the home loan as against the offset. Your thoughts on that?
Both work. And again, it comes down to what your future plans are. With the offset account, it is a daily transactional account, and you have your salary put into it, and you pay your bills and groceries and your fuel and all of those sorts of things. Where I find it doesn't work for some people, if they're a bit spendthrifty, it can be a bit of a challenge because the money's readily available.
True.
If those same people had thrown the excess money they had into the actual home loan, then to get it back out via a redraw does take a bit of effort, and therefore the money tends to stay in the loan rather than get used on, as I referred, dog food and toilet paper.
Well said. I think we've referred to this now a couple of times in terms of there's got to be a strategy. And I think for the most part, people find a house, find a loan, get into it, and there's no real strategic thinking about this space in their lives. What would you say to someone who's actually looking to buy their first home even at the moment?
Yeah, look, and again, that's a very valid point. One of the sad situations in the country is that there is no formal education provided to people how to manage A, their money, and B, a home loan. People go to school. A lot of people go on to either a TAFE to do a trade, or they go to university and get a degree, and they're taught how to go out and get a job and earn money. But none of these institutions teach people, once you have the money, what do you actually do with it?
True.
How do you save? How do you budget? And then when you do get a home loan, the thought is, oh, well, I've got a home loan. It's over a period of time, say 25 or 30 years, it's just standard. And my monthly payments are X. And so I will just pay X. Nobody's actually there, particularly not the banks, because it's counterproductive for them to teach people how to save money on interest, because it's that interest that is the profit that the banks are making every year.
Absolutely.
So, as I say, it'd be counterproductive to teach them. And this is where companies like Borrow First comes to its own, because it's actually teaching people how to save money on their home loan by reducing the amount of interest you pay. See, an average home loan today in Australia, you will repay. So if you borrowed $800,000, you will pay around about $2.4 million if you keep that loan over its full term.
Wow.
It's about double the loan is the interest
Mhm.
over a 30-year period.
Mhm.
That used to be higher when interest rates were high, but around that double today. And that's a lot of money
Very true.
in interest. So to learn the strategies that allow you to save on that
Mhm.
can have a significant impact on your overall future wealth going forward.
Excellent. Excellent.
So, Kieran, I'm sure it'd be fairly obvious to our audience. You may not have been born here. You probably, like a lot of people that have come to Australia, you've migrated at some point in your life.
Mhm.
How has that impacted on you as a migrant? What have you seen? And what possible disadvantages have you personally experienced being a new migrant into this country?
Thanks, Steve. I think it's a very relevant question. And in this finance conversation, I think it's one that must be had, that I think hasn't been had for most people. I migrated here at the age of 30. I was married at the time. I had a young son. He just turned 1 year old. And this was around 2003, I think June of 2003, that I got here. But the interesting part was when I landed here, the cost to just get here was substantial. I was on a very good income back in India. And when I got here, much of it was spent in the migration process. I remember the first $30,000 that we had, much of it went to our 2 cars.
Yeah, right. Yeah, that's
Yeah.
right. Transport.
Fortunately, both of us working and family here to support us, we were able to get into our first home in the first 2 years
Wow.
and get out of renting, which I think a lot of people these days really can't afford.
Yeah.
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 I was a home finance manager in Westpac, and I saw a lot of people who were born and brought up here were so much better off, not just in terms of the amount they were earning, but the amount that they had saved up in, their super account was much better. The amount they had in savings to actually put a 20% deposit was significantly better than the opportunity I had.
Mm.
And it really opened my eyes to consider what might happen in retirement, because I've come from a background which I had 3 servants in the house, right? One to cook, one to clean, and one to take care of, the kids. I had a person who washed my car every morning. I had a driver for my vehicle. And I think most people who come from at least the South Asian kind of background, would have had that luxury. And just looking into the future when we hit retirement with people who've been here from the age of 16, like my sons at the moment, have started their super account at the age of 16.
Yep.
And if I'm retiring along with them, I've got 50 cents in every $5 that they've got to use to basically enjoy a good, a lovely holiday, go on a cruise every now and again, upgrade their cars. While the typical migrant will be struggling to stretch the dollar to meet even, the specials at a supermarket. And that's really critical in the reason that we've actually focused our efforts in Borrower First to identifying areas and benefits of saving on their primary residence, because it is the biggest step, it is the largest asset, and it's the largest amount of debt. And if someone who's coming here at the age of 30, by the age of 40, they've got into their home, and now they're looking at 30 years to pay it off. They're hitting 70 by the time they're going to pay it off by the normal trajectory. Something's got to give.
Yeah.
And I think it's really important that people consider this, because without a personal finance strategy, they've actually put themselves into a situation where they're not going to be able to have the time to enjoy with their kids, forget their grandkids. And it's going to be a very poor lifestyle in retirement. A time when I think they've earned, after all the hard work and making this big shift, earned the right to enjoy a good retirement, especially in Australia, where, life can be really good in retirement because you got the time, if you have the money.
Yeah.
And that's the area that I think is of great focus.
Yeah. No, it's spot on. It's interesting you say that. Coincidentally, yesterday,
Mhm.
I was talking to one of my neighbours
Mhm.
who, they are Indian
All right.
and approaching retirement.
Mhm.
And he actually spoke to me and said, Stephen, I'm approaching retirement, but I've still got this fairly hefty mortgage.
Wow.
And I'm thinking, well, I'll be able to pay the mortgage out with my super.
Mhm.
And I went, well, look, yeah, a lot of people think that and a lot of people do that.
Mhm.
But once you've spent the super on paying off your home loan, what are you going to live on?
Mm, mm, mm.
And that raised his eyebrows, and I could see he was thinking, and the only solution that he was able to come up with was, well, I guess I'll get an age pension.
Mm.
And I went,
What's
that's
that at
not
the
a lot
moment?
of money to live on.
Is it $27,000 for a couple or something
Like that.
Yeah.
Yeah.
That's shocking because I think the cost of living based on our calculators at the moment is about $50,000 or $60,000 for a couple in Sydney. At a very
By the time
basic,
you run a car,
yeah,
pay your council rates and your water rate and insurance. Don't start on insurance. The cost of that's going through the roof. The price of fuel, energy, electricity. 50,000 today is a conservative number for a couple to live. And that's not champagne and caviar. That's fairly basic living.
dal and rice, as we say in India.
That's the one. So, yeah, it's frightening to think that people are going to get to that stage. And again, this couple, they weren't born here. They've migrated. So they obviously don't have the same level of super as somebody who started, as you say, at 16. So yeah, they're going to be doing it tough, and they're the norm. And I would point out as well, they're living in a home that's probably worth in excess of $2 million.
Very true.
So they've got this massive amount of equity in their home, but you can't take a brick down to the supermarket and exchange it for some food. So
Yes.
all the equity in the world is useless to you when it comes to just your basic living.
Well said. And I'd like you to just touch upon, because I know you've been doing this for now, how many, 40, 50 years?
50 years.
But I know you've also very involved with the Rotary Club, and you have a lot of different communities there that are part of your Rotary Club. A bit of an insight in terms of, what some of the challenges are that are coming from those clients there in their financial lives.
Yes, you're right. Our Rotary Club, very diverse in terms of where people have come from. We have people from Fiji. We have people from Africa, different parts of Africa. We actually have some fair dinkum, as I refer to them, fair dinkum Indians. So they're the ones that were actually born in India, as against a lot of Indians that are born in other countries and come to Australia. They, with their children, are seeing how difficult it is to live. They naturally, like most people, want to give the very best to their kids, to help their kids, give them a hand up, to be able to get a home of their own down the track. They're, in a lot of cases, moving into getting investment property as a vehicle to help, because they're seeing, if all we do is pay off our home, as I said earlier, you can't take equity to the supermarket to buy groceries. So one of the solutions is to look at getting investment property, and gaining that capital growth over time, which then can be converted to cash at a time when you do retire, and obviously then you have a much more stable retirement, and you're able to possibly enjoy some of the fruits of your labor.
Excellent. Touching upon that, because one of the things I found quite interesting was this comparison rate they have across home loan products. And the more I look at it, I'm always challenged with, it's supposed to be the basis on which a person can decide whether you go with A, B, or C product or lender or whatever that is. Your thoughts on comparison rates?
Yeah, so comparison rates were brought into Australia a number of years ago now. I can't even remember exactly when it was. It was a concept that was picked up from, believe it or not, New Zealand.
Oh.
And it was thought that having a comparison rate will allow people to fairly compare the different loan products from the different providers. The theory is great, no two ways about it. In practice, however, it fails dismally because comparison rate is based on a $150,000 loan over a 25-year term.
Mm-hmm.
Nobody today borrows 150 grand. Most people, because they're having to borrow so much money, are taking their loan terms over 30 years.
Mm-hmm.
And when you change the parameters of the calculation, it distorts this comparison rate
Mm-hmm.
to a degree that makes it unviable. So not a big fan of comparison rate, certainly not as a way of comparing the different loans that are on the market. And when I talk to people, I just say, look, ignore the comparison rate.
Mm-hmm.
Because the other part of that as well, very few people today stay in their home for that length of time. So as soon as you sell your home and you discharge that loan, the comparison rate that was there when you first started, again, distorts significantly.
Excellent. I know you've been very instrumental in building this amazing home loan potential saving calculator. And I know it looks at the net interest rate. Yeah. In comparison to the comparison rate, yeah. Give us a little thought process of how effective is that to consider as against what is the industry standard as a comparison rate at the moment?
So the calculator will look at the home loan,
mm-hmm.
the methodology that we teach people, the strategies to reduce the interest, and then based on the reduction and eventual discharge, paying off that home loan over a much shorter period of time, we then look at the total interest that's charged,
mm-hmm.
and we calculate what the effective interest rate has been over that total time. And with the strategies that we're teaching, the effective rate is significantly lower than the actual rates that are advertised out there, and certainly dismantle, for want of a term, the comparison rate, or the use of a comparison rate.
Yeah, because in some instances, I think I've seen people on a 6.14 interest rate might actually have a net interest rate that's sometimes as close to 2%.
That's exactly right.
Yeah, and I think that's a big stress relief, because a lot of people keep chasing that, in terms of that interest rate. And I think that's another topic that we should discuss, isn't it?
It is chasing interest rates. It's probably, I don't know, there's probably comparable things I could talk about. But, changing the problem for people when they change lenders and trying to chase down the interest rate, lower interest rate, when they go to the lender, appreciate that if they go to a bank, the people working there are working for the bank,
True.
Not for the client. So obviously people are much better off going to a mortgage broker to get assistance. But one of the biggest problems I've seen when people refinance is they may have had the home for, hypothetically, say 5 years,
mm-hmm.
Out of 30 years. So they've now actually only got 25 to go.
Mm-hmm.
But when they refinance, they blow it back out to 30.
Oh, okay.
And that has a significant impact on the overall amount of interest that they will pay, even though the interest rates come down. But because they've blown it out,
mm-hmm.
the amount of actual interest they're going to pay significantly rises. I find when I'm helping people to refinance and they're, say, 5 years into a 30-year loan, I'll start talking about, well, hey, guys, how about we refinance? We'll cut it down to 20 years.
All right, okay.
So you're actually going to save that extra 5 years.
Mm-hmm.
If you think about an average home loan at, say, $5,000 a month in repayments,
mm-hmm.
5 years is 60 payments.
True. Wow.
60 payments of $5,000 is $300,000.
Yeah, that's a good money back in your pocket, isn't it?
And that 300 grand would be interest.
Very true.
That you would have to pay.
Very
so
true.
Not paying it,
mm-hmm.
obviously, reducing your loan term has a big impact. But I say, conversely, if you blow your loan back out to the 30 years,
mm-hmm.
then you're going to pay that 300 grand again.
Very true.
You've already paid it once in the first loan, and now you go to a second loan. And then I've seen people who've had 3 and 4 loans.
Mm-hmm.
And every time they do it, they blow it back out to 30 years.
Absolutely. So looking back at this calculator, one of the greatest effects I feel in that calculation is the benefit of the offsetting facility. Yeah,
Yep.
right. And that has the impact on the interest and all of that. So comparing the offset as against a redraw, given the fact that a savings account is guaranteed by the Australian government, as against what money is in the home loan could be consumed up by the lender, and your limit could be dropped. Thoughts on that? In terms of the effect that offset actually has in the calculation that we do on your potential savings calculator.
Yep. When you have a home loan and you have either redraw or an offset, the actual benefit of every dollar is identical. So whether you put that $1 into the redraw or the $1 into the offset, it will reduce the amount of interest you are then subsequently paying on your home loan. I talk to people, I look at people and their spending habits. People with good spending habits, so these are people who possibly have a credit card that they pay in full every month. I will suggest that an offset to them is a viable option because they're good at managing money. People who aren't so good at managing money, they are better off using the redraw facility because to get money back out of redraw takes a bit of effort. So potentially an impulse buy will not happen because if I wanted to buy that, I've got to get the money out of my redraw, put it into my account to then be able to, and it takes a bit of time. So for that reason, as I say, I look at the spending habits of people to determine what I consider is going to be in their best option.
Absolutely. Let's just dive a little bit deeper into the features or facilities we've got or options we've got on home loans, talking about principal and interest as against interest only. Thoughts on that?
Obviously, at the end of the day, we as a nation are taught that owning your own home is a good thing, and the only way you're going to own a home is to pay off the debt, which then equates to having a principal and interest loan because you're paying off the principal. Interest only is more often reserved for people investing in property as a way of reducing the amount of commitment that they have each month on the loan. And particularly in a situation, Kieran, where somebody has, say, a home loan and they've built up a significant equity and they're using that equity now to fund the purchase of an investment property. So now we've got two mortgages. You've got your home loan, you've got your investment loan. The investment loan, to minimize cash flow outflow, we make interest only. And the home loan, we continue as a principal and interest. P&I jargon, P&I, principal and interest. So that over time, the actual home loan is still reducing the debt. You're managing the investment loan, the rent is helping to pay that interest every month. And what you're banking on is that there will be some capital growth in that investment property, which ultimately you can grab when you sell the property.
Excellent. Touching upon that and going a little deeper, investments as against owner-occupied properties, significant difference in terms of making that choice, because I know you're a specialist in this area and you've helped a lot of your clients source good quality investments. What would you say to someone at the moment who's, bought their owner-occupied properties, considering an investment of some kind? Where would be a good place to start?
So for a lot of people, getting their first investment property is a leap of faith. They've probably got friends or family who may have investment property, but it's like anything. If you've never done something, doing it the first time is scary. No two ways about it.
And you don't know what you don't know,
And you don't know what you don't know. So this is where, obviously, I've had investment property for more years than I care to think about, and still do. I guide people, and in fact, I actually got another spreadsheet, but that's another story. I actually guide people into looking at what sort of property they should be looking to buy, looking at the area. Again, a lot of people, first time, they'll go, I'll buy something inexpensive because that's less risk. So I'll only buy hypothetically, $500,000 home, right? Because I see borrowing $500,000 is less risky than borrowing $1 million. And I can understand where that thought is coming from, but it's actually the reverse concept, because the cheaper the property you buy, the lesser will be the quality of the tenant.
Oh.
Because obviously rent is lower on a $500,000 house compared to $1 million house. And so you're actually going to potentially have more challenges going forward with a cheaper house rather than buying. I talk to people about going middle of the road. You don't buy $10 million homes for investment. You don't buy $500,000 homes. Middle of the road, average price. So, for example, actually, I was only looking at this yesterday. In Brisbane at the moment, it's around about $950,000 is the median price of a home in Brisbane.
Wow.
So if you were to buy that type of home, it will appeal to an average family. So average family, husband, wife, a couple of kids. Both husband and wife are working. You can put them into this home. You can be fairly certain you're not going to have any problem with them because they can afford the rent.
True.
If you buy a substantial home, as in worth millions, an average person can't afford to rent that.
True.
So then you end up having shared accommodation situation, and it may be 3 or 4 friends get together to rent the property because they all throw in to pay the rent. Something goes wrong, and everyone is pointing the finger at the other person as to the cause of the problem, and nobody wants to be part of that. So, and I say, if you buy a really cheap home, then you're likely to get somebody who can only afford that, so they're possibly not working, and that then creates its own challenges going forward.
A lot of people keep considering, once they have a certain amount in super, as to what might be the best way to invest that, all right? Being very clear that you and me, neither of us are financial planners, all right? But I know you have helped a lot of people set up a property inside a self-managed super fund. I know a lot of people would like to know more about that, and there's very little said at depth from someone with your level of knowledge. So please, if you could share some light on that, would really be helpful.
Sure thing, Kieran, not a problem. So having a self-managed super fund, and again, I've had mine since 1995. So I've got a bit of experience in self-managed super funds. It is something that people need to be aware of, that the first part of the name is self-managed, which means they have to manage this property or they have to manage the fund. It's not a set and forget situation. There are significant rules around having a self-managed super fund that are imposed by legislation that people have to comply with. So it's not a situation where it's appropriate for everyone. I have a large number of clients who do now have self-managed super funds, who do have property in those funds that I've helped, and I see that as part of what I'm doing. It's not just setting up the loan for the fund, but actually talking and taking people through all of the various requirements that they must comply with to ensure that they're actually aware of what they're doing. Unfortunately, there's a lot of spruikers out there that are saying to every man and his dog, oh, you should have a self-managed super fund. It's not appropriate for everyone. A lot of thought needs to go into it. I direct people to the ATO, for example, website, where there's some good information about running a self-managed super fund. And it's just one of those things, what you said earlier, what you don't know, you don't know. This is a situation where people need to know more and they need to study a little bit. as I say, the ATO website's a good source of information. But getting past that, if it is appropriate, then getting a self-managed super fund and getting a property into it can be a great way of using your super to create future wealth for yourself when you go into retirement. And I'm fully on board with people doing this when it's appropriate for them.
And what kind of professionals would you say they might need on their team, given the fact that they're taking on this fairly what do I call it? Intensive strategy, to manage something for the longest term, which is retirement. What would their team look like?
Well, this is where again we help people, because on our team that we make available to the clients, we have property experts who do significant research to locate property that will give you the maximum chance of doing well. In other words, gaining good capital growth in areas where there is a invariably shortage of rental accommodation. That means you're going to be fairly confident that you'll always have a tenant for your property. We have solicitors who are experts in conveyancing, property conveyancing, and depending on where the property is, not every solicitor is licensed in every state. So we have solicitors who can operate both, for example, New South Wales, Queensland, Western Australia, wherever it was. So we have these people on board that we can refer clients to. We have quantity surveyors. So one of the things that is important that most people overlook when they buy an investment property is to get a full QS report, QS quantity survey. The QS report is what the accountant will use to allow for deductions on depreciation for items in the property. Talking of accountants, we have accountants who specialise in helping people with investment property, whether that property is in their own names or in a self-managed super fund. We have a lot of what we do is with brand new property. So, for example, where a person, and you can't do this in a super fund, but in your own name, purchase land and have a house built. So we have property inspectors that will go and look at the house at handover to ensure that everything's been built according to the plan. And if there's any little brush marks, paint brush marks that need fixing, or minor things that the builder, the trades have overlooked, then the property inspector that we have on board will say, look, this needs fixing, and he will make up a report of that and give it to the builder and get these minor things fixed up, as say at practical completion stage.
Because the fear is the devil's in the detail, isn't it?
The devil is in the detail.
Where does the financial planner fit into this? Because there's a lot of people out there who can, I think, set up a self-managed super fund online these days, yeah?
You can set it up online. It's a little bit haphazard, but that's okay. No, it's important to engage a financial planner as part of the team. One of the things I've seen happen, which is absolutely catastrophic, is a person has their super, and it may be with an industry fund, and within that they have some life insurance. They then set up a self-managed super fund. They roll over the money out of the current super into their self-managed super, and in so doing, the insurance policy they had is cancelled. So now they've got their own self-managed super fund, and the somebody will say to them, about insurance, you should have insurance, and you can pay for your life insurance out of your super fund, which is a great thing that can be done. But unfortunately, in the intervening years, from when that person first started their industry fund to now, they've suffered some health issue. So now they go to get new insurance, and the cost of the insurance goes through the roof because they've got some health issue. So having a good financial planner will ensure that you haven't cancelled off your old insurance in your old super. And in a lot of cases, even if you have a self-managed super fund, you may actually retain the existing super solely to manage the payment of the premiums for the life insurance. Because, as I say, with a health issue, you may not even qualify today for insurance.
So that financial planner, from what I'm hearing, is essential, because there's so much more when you're going down this path to self-managed super fund than just, listening to somebody who's trying to flog you a property, isn't it?
Oh, look, as you said, you can do this online. The instruction, just do this, do that, boom, 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 and yep, there you go. But it's a bit like building a house. You wouldn't build a house without a plan, and you shouldn't set up a self-managed super fund without a sound plan in advance. And this is where the financial planner will come into their own and help you out.
Good stuff. Thank you. Steve, just touching upon the fact that we specialize in saving people a lot of money in repaying their loans. Your thoughts in terms of the standard statement we see blasted across every social media platform that people think the banks are ripping them off. Your thoughts on that?
It's one of those situations, unfortunately, where, as I said before, the staff in the bank are working for the bank. The bank is the employer. And just like people work for somebody and they work for that boss, bank staff are doing exactly the same. So they're not doing anything bad or wrong. It's just the way it is. When a client comes in, or a potential client comes into a bank, and this is a bit sad, a lot of times the staff are actually on a bonus system. So if they can write a loan or give out a loan to somebody, it's helping them achieve their KPIs and potentially get bonus at the end of the month because they've achieved a certain level of lending. And that can lead to a conflict of interest because they're not necessarily doing what is best for the client. It may be what the client is asking for, but if the person doesn't really understand or know too much about all this stuff, what they're actually asking for may not be good for them.
Which
And they may not know that it's not good for them. And so where a mortgage broker will suggest to somebody that maybe $1 million loan isn't in your best interest, you may be better off with something less, the banks will invariably do or give somebody a loan that ultimately may prove unsuitable over time. But in terms of the amount of the loan is what I find more often than not, just that the banks are giving out large loan amounts to people, and whilst using the bank's own calculator, they would deem that that is responsible lending. The reality is that if the person in the bank hasn't got the life experiences, then they themselves don't know that what they're doing is not responsible. Because, for example, if you take the case of a young couple just starting out and they're both working and both earning great salaries, looks fantastic, borrow a large amount of money to buy their first home, everything's rosy until they start to have a family. Then all of a sudden, there's one or more additional mouths to feed. There is more often than not then a reduction in the family income because people can't necessarily work full time anymore because they've now got kids to look after. That needs to be taken into account at the start, not after. It's like, I'll take out car insurance after I have a car accident. Well, it's too late. So you need to factor these sorts of things in before the loan's taken out and talking about the what ifs. What if you have, what happens if you have twins? What happens if you have triplets? Rather than, because often people will say, oh, look, if we have a child, the grandparents will look after, babysit the child. We won't go back to full-time work. And that's fine. But I often say to the people, what if you don't want to go back to full-time work? What if being a parent is so wonderful that you want to experience more of that?
Very true. And I think there's a limitation also in this concept of what product has been given to the person in being not unsuitable rather than being suitable, isn't it?
It's a wonderful term of phrase that is within the legislation of lending these days, where for a person to be given a loan, that loan does not have to be suitable. It just has to be not unsuitable. So it doesn't have to be the lowest interest rate or have all the bells and whistles or whatever. As long as it is not unsuitable, it's a bit like you could have a car that will tow a caravan, but the caravan is actually a little bit heavier than what the car is rated for. So the car is not unsuitable to tow a caravan, but the caravan may be unsuitable for the car.
I get that.
Same concept. So yes, lending, responsible lending, and having a loan that's not unsuitable, as against having a loan that is suitable, is one of the, as I say, it's one of the parts of the legislation.
Yeah, and you've also touched upon this. I think a lot of borrowers in that phase where they're looking to buy a property or even refinance a loan, what they ask for more often than not is rate-based, isn't it?
More often than not, it is only based on the rate, because generally, what else do you compare? Obviously, you could go to the yellow bank or the blue bank or the red bank. A lot of people are colorblind. When it comes to a loan, the loan itself is money. So there's no comparison. Money is money. Most lenders will do 30-year terms these days. So it's not like, oh, well, I'm going to this one because of the this one will give me a longer time to pay off the loan as against somebody else. So the only thing that people can actually see and consider is the interest rate. And whilst that is a part of getting the home loan, and it's not the be all and end all, but it's the only hard and fast part of the home loan that I say that people can actually look at and say, well, this one is this rate and this one is a different rate. So it'd be like going and buying, go and buy a motor car, right? You know what sort of motor car you want. So you go to a number of different dealers who sell that particular car and negotiate to get the best price on that particular car. And that's the price of it.
True.
But interest, and you get the car. But home loan doesn't work the same way.
So there's a lot more to the loan, and I think the structure of the product must suit the way the person earns and spends their money at the moment.
Earns and spends, very practical.
Yeah.
The overall thing that needs to be considered is you're taking on a commitment that in nominal term could be 30 years. And what is appropriate today may not be suitable in the future. And whilst you can't see necessarily into the future, you can predict things happening. And you need to assess how life changes are going to come into play during this term of this loan.
Very true. What we've also noticed, and I think you brought this up about looking at your loan like a vehicle in one shape or form. If we chose to look at this like a manual vehicle, would you agree that most clients are stuck in first or maybe second gear and actually not moving ahead and actually using even some of the existing facilities they have very effectively?
That is very true, because people, there aren't courses out there that people can take to learn how to manage their finances, how to manage a home loan. Often advice that people follow comes from well-meaning friends or family members who they themselves may have trouble balancing their own family budgets. So would you want to take advice from somebody who's not necessarily doing super well in, say, managing their own financial situation? And I'd like to think that this is when, or why people come to talk to me, because I look at the whole gamut of what's going to happen in the future for them, realistically. And it could be that we go from a couple to a family with children. How old is your current car? Is your current car going to last 30 years? Well, no, it's not. Okay, so at some future time, you're going to want funding for a car. So one of the best things you can do, and here's an example I use with people. Let's say a car's going to cost you 30 grand. Your current car, if you trade it in today, might be 5. So you're going to need 25. Most people would go, yep, okay, I'll go and buy a car for 30 grand, trade into the old one. I'll get a loan for $25,000. Car loan, not the cheapest finance that is available. Where I would say, okay, let's look at, in 5 years' time, you're going to want a new car. You need $25,000 because you're still getting your $5,000 trade. So 5 years, $25,000, $5,000 a year, $100 a week. So if you start putting an extra $100 a week into your home loan for the next 5 years, in 5 years' time, you'll have in redraw 25 grand. You can now go and pay cash for your car.
Awesome.
In the meantime, you've saved interest on it. And another big factor that I always point out to people, if you pay cash for a car, the car insurance is cheaper.
Oh, is it? Okay. All right. Yeah, I think so.
Yeah. Because one of the questions they ask when you take car insurance, is it financed? And if you say yes, then the cost of your insurance goes up. So over the 5 years, I've taught people what to do. They've saved a significant amount of interest on their home loan in the interim. They've then taken the money out to buy the car. And I tell you one thing too, when you go to a car dealer, if you offer him cash, you can often negotiate a better price.
Very true.
Like, how much for cash? That's something we learned from the Indians.
We're good at that.
You're good at that.
Nothing less than a 20% discount.
Yeah. And as I say, save on the insurance. And ultimately, the saving to the family is significant. And it's just thinking about the changes and what happens in life. And I'm able to help people this way because I've gone through all these things.
Very true. Very true.
Marriage, family, cars. Paid cash for my car.
Awesome.
Using that method.
The more I hear
I did get a discount.
The more I hear you talk about this, that structure around the entire product, really critical. Yeah. And I think also what the question being asked, I recently had a client who was on one of the cheapest rates in the market. I think it was a 5.84 or something like that, when the next best rate was about 6.14. And it was quite interesting. We looked at him and said, we put it through the calculator and popped up a $580,000 saving by moving to a more expensive interest rate. Now, most people would say, nah, I've got to get a cheaper interest rate if I've got to save some money. But there are a lot of nasty products, if I can call them, the basic products at most lenders that don't offer you certain features and facilities. Your thoughts on that?
It's very true. And it's, again, to compare, it's like going to the supermarket and buying packet of vitamins. And these might be a 500 milligram vitamin C.
Mhm.
Most medical experts will say that you actually need more than 500 milligrams
Mhm.
a day. Okay, well, if I need 1,000 milligrams, that means I've got to take 2 a day. But if I buy a packet of vitamins that is 1,000 milligram, so I only have to take 1 a day, that packet of 1,000 milligram vitamin C is 50% more expensive than the pack with 500. But because I only have to take 1 and not 2, it's going to last longer, and therefore there's a saving. And it's similar with home loans, that you can just, as we were discussing, looking at it, the only thing you focus on is the interest rate and not the other parts of it, you can be fooled into thinking that that is singly the best for me, because you haven't been taught all the other things around what's important with the home loan.
Excellent.
So things like the offset, for example.
So, Steve, you keep referring to home loans in a vehicular manner, and I love that kind of what do you call it? Simile? Analogy. Yeah, right. I look at the discussion in terms of sport, yeah, because we Indians love cricket, all right, and I think a lot of people actually treat their home loan or the game of finance like they're actually playing the game of cricket, and they're only focused on someone's trying to get their wickets. Yeah.
Yeah.
And they're guarding against everything, because even the runner at the other end in most games tries to get you out. We see that happen in a lot of the World Cup matches these days. But when I look at finance, knowing what we know today, I think it's more a soccer game, because you need somebody at the back in our capacity saving you. We call ourselves the goalkeepers.
Goalkeeper.
Yeah? So that the couple up the front can shoot the goals that they intend to achieve out of this entire game, isn't it? And between them and the goalkeeper, they need people to basically make things happen.
Yep.
And I love that way, because sitting in our position today, as we go through this conversation, we've got visibility of what's happening on the game far better than the people up front. And you don't want them having to come back all the time just to see what's happening on the field and go back to shoot the goals. It's that kind of a thought process that I'm usually trying to share with clients moving forward. Yeah.
Yep.
Right. What are your thoughts in terms of a person that's sitting on an existing loan at the moment, struggling with the cost of living, struggling with interest rates having gone through the roof over the last 24 months? Yeah. What would you say to them in terms of what should they be thinking as their next steps?
Using your analogy, obviously, as a goalkeeper, we're looking down the field and we can see all the things that are happening on the field. As against the striker, who's at the front scoring the goals, for him to see what's happening, he's got to actually turn around and look backwards, which is not productive. For people with current loans that they're struggling, they need to engage professionals to coach them on the things that need to be done to find out how best to manage their money, to discuss the benefits of different types of loans and the features that they come with, working hand in glove. Goalkeepers usually wear gloves, working hand in glove, to be able to survive this period, where, as you say, the cost of living pressures on top of the fact that interest rates went up significantly compared to what they were, albeit they were artificially low, no denying that, and knowing what to do with their money. And it's that coaching that we do that is critical to helping people. And we don't just set up loans for people. We follow up with the people, find out that they're managing, that they're following the plans that we have set in place for them to be able to manage their money. It was funny you raised the topic, but a couple that I helped recently, and a few weeks after they'd settled, and in this case they did actually refinance to another lender, but the other lender had better product for them, and the husband had come back to me and said, things not working, and I said, okay, go back to what we talked about, because I had sat down at their dining room table with them and run through the process. And I just put that down again as to this is what we discussed you would do, and set it out in point form again for them. That's the second time. And then 2 weeks later, I checked again and he went, yeah, it's working now.
Excellent.
So
that's so good to hear.
I understand that things don't always work first time perfectly, and that it does take a bit of effort to change. It may be that you are used to catching a bus to work, but now there's a metro, so you're actually better off on the metro, but that's a change and you've got to get used to that. And it's the same with the home loan. There is often a change. And for a lot of people who have never been taught how to really manage money, it's a significant change to the way you treat things, the way you do things, the way you spend money, where you put money. Once you get it nutted down, and you start to realize that you're achieving this benefit. And again, with that couple, we reduced, I think we took another 3 odd years off the nominal term of the loan.
Wow.
Which was 36 payments. It was $150 odd thousand, ultimate saving for them.
Beautiful.
Which was, these are significant numbers.
Yeah, because at the end of the day, if you come to think about it, somewhere between 60 to 70% of a person's gross income is lost to taxes and their mortgage or whatever the housing situation is.
Yeah.
Right? And that's a significant chunk. I know people who drive a couple of extra kilometers to get a couple of cents off the liter of petrol or diesel.
Yeah.
Right? And when you think about it, to most people, there's about $100 to $150 a day that they could be saving by just getting a really good structure, getting a personal finance strategy in place. All right.
Yeah.
And I really want to thank you today because you've shed light on so many important topics. And we're definitely going to come back for another conversation very soon.
Not a problem. It's been a pleasure joining you today. And let's hope people actually take advantage of what we offer.
Excellent. Thank you so much, Steve.
Good on you. Thanks, Kieran.
Pleasure.